Hi, welcome back to Academic Market Insights. Today is a very exciting day because we will be discussing VIX over a holiday weekend, and we are approaching a 3-day holiday weekend. Yay! We're going to be celebrating the 4th of July, which, if you are an American, I hope that you are celebrating by blowing up a little piece of it or at least enjoying somebody else who is blowing up a little piece of it by watching some fireworks. But as Dr. Rowe would tell you, the VIX will be sleeping over the weekend. So let's dive in and find out what the VIX typically does on these 3-day weekends. And if you haven't already hit subscribe, please subscribe. And if you like this video and you like fireworks, please hit like.
I feel like I should have done better in the graphics on this one as you talk about, blowing up a small part of the country, etc. I don't know about you, but kids, they're already blowing stuff up in my neighborhood. I assume they did the trek up to Wisconsin and picked up all their fireworks and came back down, and now they're rationing them over the next 5 or 6 days to drive my dogs absolutely bonkers. So since we've got Independence Day, the 4th of July coming up on Friday, and that's a 3-day weekend. And then also, I do appear on a show called Volatility Views every Friday morning. Not this week because we're on vacation, but I often talk about when a 3-day weekend's approaching, the impact it might have on VIX, etc. But I also warn that there's not really much of a money-making opportunity off of it, but you do need to be aware that VIX is impacted by the level of VIX is impacted by a 3-day weekend. And we'll get into why that is. Just so folks know what VIX is at a very, very high level, it is an invention from another academic, Dr. Robert Whaley down at Vanderbilt. He's the father of VIX. And he came up with a consistent methodology to display 30-day expected volatility for the S&P 500 using S&P 500 index options. And it's gone through a few changes over time. The way VIX is calculated now is because we have such an active market for options expiring every Friday, or weekly options is what we called them before dailies came along. The SPX weeklies that expire just before and just after the 30-day time frame, those will be what is used to calculate VIX. Sometimes, depending on where we are in the calendar, the old school third Friday standard SPX series might be part of the VIX calculation. But the main thing to be aware of is VIX is calculated using calendar days. And when we have a weekend off, that creates when we have 2 days off like a normal weekend, that creates a little bit of a headwind for VIX. It also creates a bit of a tailwind on Mondays. When we have the 3-day weekend, we get that relationship is accentuated, and that's what we're going to show today. I'm also going to show, and as I kind of mentioned in passing there, it's the spot VIX is the one that is impacted. VIX Futures, not so much, and really want to demonstrate that this 3-day weekend effect is something that impacts VIX, but doesn't necessarily impact the futures contracts. And that means that you should not run out and get long VIX over a 3-day weekend based on the tailwind that it's going to have on at least this week, Monday morning, if we had a Monday off, a Tuesday morning. In the VIX futures market, we have weekly and monthly expirations available. The monthly expiration is typically on a Wednesday, and it is 30 days before the next standard third Friday expiration. And again, not taking holidays into account. When December rolls around, we'll be back in this place talking about how the extra holidays over that season have an impact on the December futures contract. But 3-day weekends, not so much with respect to VIX futures. And that's because there's no fair value relationship between spot VIX and VIX futures contracts. It's very difficult. I'm defaulting to when I worked for SIBO, and I was supposed to tread on this one lightly. I'll be more straightforward. It is impossible to replicate the performance of spot VIX in a portfolio. If somebody had did it, we would see trading activity and arbitrage activity that keeps the two markets in line with each other. And we don't see that. In a nutshell, VIX pricing is determined by the SPX market, and VIX futures by supply and demand in the futures market. And that means that sometimes VIX futures are at a discount, and sometimes they are at a premium relative to spot VIX index. It also means sometimes the VIX futures may go down in a day, and the VIX index might go up. Yes, Dr. A.
I have a quick question about
Sure.
why is the spot VIX not replicable? Why aren't people doing this?
Oh, absolutely. So when I was at SIBO and I was working at the education division, I would be invited to go talk about VIX with analysts and quants at some of the trading firms around the Chicago area. And it was always a very one-way conversation because they were trying to figure this one out. And I say that if someone had figured it out, we would see it trading wise because a lot of really smart people have tried to figure it out. Now, the reason it is prohibitively expensive to replicate VIX in a spot VIX in a portfolio is because VIX, and I'm going to go back one slide here, VIX is using two different SPX series expiring just before and just after that 30-day time frame. Well, the time component of VIX is updated, I think, every 15 seconds. So every 15 seconds during a trading day, or VIX is calculated maybe every 15 seconds. I think maybe every minute, the time weighting is changed. But frequently throughout a trading day, the nearer dated SPX options are weighted a little bit less in the VIX calculation, and the farther dated ones are weighted a little bit more. Also, only out of the money option contracts are used to calculate VIX. So it's all the out of the money puts and out of the money calls. Well, if you're trying to perfectly replicate that and the S&P 500 crosses a strike price and the strike price increments 5 points, so every 5-point move out of the SPX is also going to throw out some options and include new options. The trading activity in order to keep up with all of that is just too costly. VIX is calculated using the midpoint of the SPX option contract prices. Anybody that has traded options knows that getting filled at the midpoint is very, very difficult. You have to give up, you have to buy a little bit above the midpoint, or maybe even on the offer, or sell a little bit below the midpoint, or even buy on the bid side. Sell on the bid side. But in either case, just the slippage alone would be insurmountable as trying to replicate VIX in a portfolio. It's just not as easy as replicating the S&P 500 in a portfolio.
I also wanted to ask, and this is something we don't really go into the weeds on some of this, but I think for some of our viewers, it might be very valuable. Why does arbitrage force prices in line? So why is this a big deal, and why is it something we're spending the time discussing?
Well, arbitrage is very important and I'm going to stick with the S&P 500 futures because it's a closely related market. But if the legitimate users of S&P 500 futures are portfolio managers that are trying to increase or decrease their exposure to the market, and then we've got market makers and arbitrage traders that are really just trying to make small profits by, maybe offsetting the other side of a futures trade by doing something in the underlying ETF or doing something in a basket of stocks that replicates a longer short position in the index. You can do that in the S&P 500 market because it's easy to replicate performance of the S&P 500 in a variety of instruments. And it's important for the overall markets because it helps with the integrity of S&P 500 futures pricing, keeps those futures within a fair value of the index, and you're demonstrating it there on camera, keeps them in line with each other, and gives the legitimate users a little bit of comfort that they're getting pretty close to one-to-one performance with the underlying index when they trade the futures.
And it's, again, the reason why I'm asking and bringing these points up is this is one of the reasons why when we think about the VIX and we think about the fact that there is a discrepancy between the spot and the futures, it's something that we need to be conscientious of, and the difficulties and why it's not the case and why this is a unique instrument.
It's an extremely unique instrument. It gives me enough to talk about every week. So even on quiet weeks. So it's a very unique market, and those that have gone through the trouble to try and master it, I think, have done very well with it. All right, let's get into the data part. This is the closest thing to fireworks that we have here. So what I'm starting out with here is what is the average change for VIX? What is the average change for VIX future on all of these pairs of days? And when you take a look at, I hate to jump to the very bottom, but you can see that from the Friday close to the Monday close, and that's the bottom row here, the average change for VIX is a gain of 31 cents. The average change for VIX on Fridays is lower. And this is without the holiday impact. You can also see, and I'll touch on the top three rows very quickly. They're all pretty consistent. You do have a little bit of a drop Monday to Tuesday for VIX, but VIX is higher between 42 and 45% of the time when you're talking about Monday, Tuesday, Wednesday, or Wednesday, Thursday. And same thing with the futures. They're basically up between 40 and 45%. So there's not a whole lot of difference. I know that the average change, there's some difference in there, but in general, the price activity for those 3 days are all very similar. Thursday through Friday, that's the second worst day for the VIX future. Friday through Monday, as far as a price change, that's actually the worst day as far as VIX futures rising. They only go up 38% of the time on Mondays. The VIX index is up. That's the big outlier number there, 55.84% of the time. Now, if it were possible to buy VIX, you can make an average of 31 cents, buy spot VIX, you can make an average of 31 cents. If you tried to replicate what I'm showing you with the index in the futures market, you would actually have a loss. And that's in my mind, it's very important to make sure that we get that point across, that even though we found kind of an interesting anomaly, there's not really much of a way to go about trading it.
Right.
And then here's the big reveal. So how does VIX how does VIX do after a 3-day weekend? 3-day weekend, the average change for spot VIX is up 74 cents, and the VIX index is higher. Spot VIX is higher 71.12% of the time. Look at what the average VIX future does, and the VIX future is only higher 40.14% of the time. So you've got a very, very big divergence between the two. And then also, just to flip back for 1 second, you can see that the average change in the VIX index is much, much higher than any other pair of days that we see after we're coming back on a 3-day weekend. And that's because it really comes down to implied volatility is a function of time value. And the time value of these options, they adjust a bit going into a long weekend for that extra day off. And then once we get those 3 days behind us, you actually, you see a resumption of a bit more normalcy in the price of VIX, and you see that bump. Now, before we get to the 3-day weekend, got another day, and this is another one that's kind of interesting. I took in this is after 3-day weekend. 3-day weekends we can have a Friday off or we can have a Monday off, and if we have either of those, VIX is only higher 32.17% of the time before a 3-day weekend. Wow. So one of these things that you could look at is, maybe the S&P 500 is down a bit, and you wonder why VIX is down on a Friday before or on a day before a 3-day weekend. Well, that's more of a calendar impact than VIX having an inverse relationship with the S&P 500, which is what we normally expect. Sometimes if they both move down together or they're both moving up together, that can be taken as a signal. I tend to not put a whole lot of weight in that relationship on the Thursday or Friday before a 3-day weekend. You can also see that before a 3-day weekend, the VIX Futures under a little bit of pressure as well, which I do find a bit interesting because it doesn't get quite the same bump that spot VIX gets on that, after the 3-day weekend. Gets a little bit of one, but not nearly that 74 cents. So there you go. Yeah, pretty straightforward relationship between VIX and what day of the week it is, and between VIX and when we all get a 3-day weekend.
Yeah, and I think it's important, though, the discussion of like how it's not a profitable area, because that's, I think, everybody's first thought is when you see that is like, how do I capitalize this?
Yeah. Yep. And years ago, somebody had posted something about how on Twitter about how you look at this anomaly in VIX. And I DM'd them. I don't get into discussions on Twitter about things like this. I DM'd them, and I explained it, and they were really rude to me about it.
Oh.
So I even try to be gentlemanly and do things via DM, but they were like, okay, I'm listening. I'm like, well, you know what? I'm just not even going to make the effort. So there. So, all right. With that, I'm going to take us out because I always make you do it. So with that, hopefully you got a little insight into VIX and maybe, when you're pre-gaming for the 4th of July weekend on Thursday this week, and take a look at VIX. After I went through all of this, it'll probably be higher on Friday for some reason. We are in an unusual world, and you never know what may happen. But we always appreciate you guys joining us. We are wide open to topics. We're actually going to expand some of the things that we're going to do. We're going to try to do some short videos where we answer very quick questions. This one was borderline short video. And, just hit the like button if you found some use in this, and hit the subscribe button to know when we're posting more videos. And with that, we both hope that you have a very nice 3-day weekend.
Thank you.